Welcome to the next in the series of the SSER Ideas lectures on the COVID and the impact on the economy. Today, I'm very delighted that we have with us a very old friend, very eminent and dear colleague, Professor Erinç Yeldan from Bilkent University in Turkey. Erinç is one of the foremost macroeconomists in Turkey. He's done a lot of work on modeling general equilibrium, looking at the impact of financial crises, of adjustment, of income distribution, on the environment is among the recent areas that he's worked on very extensively. So I'm absolutely delighted that Erinç has agreed to give a talk on the new normal and what we will have to get used to. I really look forward to hearing Erinç because I'm sure he will have some very interesting ideas about how we can cope with this absolutely extraordinary situation that we're all in and what we can expect in the future. So without further ado, let me request Erinç to start. Please, Erinç, go ahead.
Thank you, Jayati. Thank you all who is joining us from all around the world. I hope that we'll just have a enjoyable hour with all of you. Okay, comrades, let me just start by sharing what I have in mind today without losing more time. This is kind of what I have prepared. The subtitle speaks for itself. We are facing, or we used to be facing, just before the eruption of the COVID crisis. We have been already in the era of lopsided growth, stagnant investments, fractured or fragmented labor markets, collapsing profits, stagnant wages. As a matter of fact, all prices were collapsing, commodity prices, inflation was low, wages were stagnant, profits were low, productivities were low. We were into a really volatile, stagnant economy since more or less the beginning of the millennium. Now, first of all, let me just set the stage for our research agenda under this, what we call the new normal, or it used to be called the new normal. It's already the old normal. The characteristics of this research agenda under this old normal, not necessarily true for economics in particular, but more or less shared in all aspects of social sciences. First of all, this traditional mainstream agenda was coming up with standardized questions, and to these standardized questions, there were cookie cutter standard answers, which were tend to be memorized, and we were sharing diplomas and degrees based on standard everything. Questions, answers, and memorization. In this standardized framework, questions of income distribution were outdated. They were taken out of the curriculum of all social sciences agenda. And there was this fetishization, the gospel of markets, devotion to the age of great moderation, that this old normal consisted of central banks charged with inflation targeting, exchange rate regimes should be flexible and free float, there should be no intervention whatsoever in the realm of markets, trade should be liberal, free, and the finance should be devotedly free and mobile, and the transnational corporations should not have been taxed, and the FDI was the notion of the developing world, that in order to develop and grow, you have to embrace globalization, open up your economies, embrace the FDI that the transnational corporations were so generously coming over. One of the standard stories emerging out of this research agenda, or I should say teaching gospel, was this idea of harmonious growth, this convergence across the global economies. This data is from the standard world indicators. It shows the ratio of weighted per capita GDP of less developed countries average, per capita GDP in less developed countries as a ratio to that of the United States from 1980 to the eruption of the global crisis in 2009. At first sight, you see this picture and you get a picture that, somewhat around 1980 until the millennium, there wasn't much of a convergence, but as these less developed countries started to embrace globalization, enter the world markets, and there had been a triggering of convergence, and the less developed countries, as a ratio of their per capita GDPs, started to follow up, close the gap against the United States. Now, you have seen perhaps many pictures of this sort, and this is always subject to ifs, howevers, and buts. I'm not going to play around any of these on the one hand, on the other hand, howevers or alternative explanations. All I'm going to say is that this picture itself is a facade. And the way it's facade is just, let's look at the numbers on the vertical axis. Until now, I have taken your attention elsewhere to the anything but the size of the vertical axis. Whatever the convergence we have been talking about, according to statistics, is actually a development coming from 1.5% to something on the order of 3.2%. As a matter of fact, using the same numbers, if I simply change the scale of events, making it a more useful figure from 0% to 1% only, sorry, 10% only, then we see that actually whatever convergence that one might even talk about is almost nil. That is, it's only a matter of scale and time. And if things go at this rate, without any COVID crisis or any other commodity price shock, any other technological shock, if the world was going what the economists love to assume, ceteris paribus, over decades and decades and perhaps even centuries on, this convergence will take more than a century to make any meaningful dent in this convergence gap. It is slow, it is marred, it is subject to volatilities of the global market. It will be a whim. So what in our theoretical episodes, what we had been forced to teach in the mainstream agenda has very little to do with the real world observations and historical realities. This harmonious globalization being one of them. Let me continue my story. What was the real path? Well, among many observations, what we could have generalized on the ongoing pathway into the 21st century, one, the world economy was on a slowing trend. Two, whatever growth is out there, it had shifted from what the ILO and OECD has highlighted as jobless growth at the turn of the century to something what again OECD is calling wageless growth. There is growth, but not translating into wages, not translating into decent jobs and not translating into formal labor opportunities. All of these are characterized at the background with over-concentration, oligopolization in the global commodity and the service markets. In the meantime, we are also observing a shift in the industry's share of production and employment towards innovation-led, high technology-driven, robotics-driven, financial-driven services sectors. What is interesting is in today's already developed industrialized world, this may be termed as a natural course of events where industries have matured, technologies have matured, and there is a switch of resources away from industry, traditional industries, to services now. What this is accompanying with is the fact that the so-called DEEs, the developing and emerging market economies, are also experiencing the same phenomenon without necessarily reaching the same degree of maturity and completing their industrialization episodes. There is a premature deindustrialization, a shift from agriculture and primary activity economies, bystepping the formation of the industrial base and going to highly import dependent, highly externally finance dependent, type of service-driven economies. This deindustrialization, coupled with the wageless growth, is putting these the future of these economies at the mercy of the transnational corporations and waiting for FDI, turning their development agendas as a welcome party to the transnational corporations to bring civilization, to bring technology, and to bring jobs, false hope. In terms of the wageless growth, this is data from the Washington, D.C. based Economic Policy Institute, their database. This is narrating the events in the hegemonic power of the global capitalist world, the United States. The data pertains to private manufacturing. According to data shared by the EPI researchers from the end of the Second War, that is the so-called golden age of capitalism into the 1970s onwards, all the way to the global crisis. What we observe is the increase in real wages, real hour wage index, coupled with the real productivities, real productivities translated into real wages growth translated into high effective demand led to the mass consumption of the Fordist era. The mass productivity, mass production has completed a virtuous cycle, so that high productivity, high wages, high demand, and high profits completed the circle. Somewhere around 1980s, this virtuous circle had been broken. Productivities had continued, but this time continued elsewhere, not necessarily in industry and the real sector, but mostly in the financialization of the global economy, as well as the United States. And the wages were stagnant, and this was the onset of the wageless growth that we were talking about. This gap, mind you, is not necessarily industrial profits. It is profits, is the rate of return to capital, definitely, but it had been captured mostly by finance capital, and these industrial firms had in fact slowly, little by little, turned into rentiers, financial conglomerates, the transnational corporations have taken over industrial as well as financial speculative activities and turned into giants, taking their profits not necessarily from real economic activity, but mostly financial returns and financial speculation. UNCTAD data. Since about roughly the late 70s and 80s, we have also witnessed a rise of financial activity all around the globe. The UNCTAD Trade Development Report 2018 had shared us with this observation. Let me start with the investment paths. This is the developed economies. As a reference to the right-hand axis, as a share of gross domestic product, national incomes of the developed world, the amount of fixed investment expenditures. You see a stagnant and almost a declining trend, as a matter of fact, since the onset of the crisis. This decline comes at a period where the gross domestic product, the real growth, was in fact on a slowing rate of growth. So in return for slow growth of incomes, the fixed investments were actually declining. So overall, there was very little fixed investment expenditures all over the developed world. This was kind of a surprise, because what we had been preached for is the fact that with the freeing of the financial instruments, the opening up the financial liberalization, increasing the variety of the financial instruments out there, we would have seen an increase of financial flows available to investments, and the investment performance of the economies will be increasing. And as a matter of fact, we have indeed seen an expansion of the financial assets and liabilities, which is reported on the left-hand axis. In terms of data back in 1980s, the developed economies were sitting on roughly about 100 trillion US dollars worth of financial assets, which had increased by 2016, so almost 500 trillions. This 500 trillions of financial assets is roughly 7 times the 7-fold of what the whole world is producing in terms of value added and real product. So we are clearly in a terms of excessively financialized world. All of this liquidity turns out to have very little to do with real capital accumulation, but in turn has a logic of its own, where financialization rebreeds itself, value is revalued, and this logic obeys no rule of gravity, and is on a ballooning economy, is creating volatilities and uncertainties to the right of the world. This is an interesting passage that I came across last summer from 2 IMF researchers, Franco Diaz and Douglas Lake. In the IMF blog titled The Rise of the Corporate Giants, they came up with this observation that there is the tendency of growing economic wealth and power from airlines to pharmaceuticals to high technology companies. This concentration has raised concerns that too much concentration and market power in the hands of too few are blamed for low investments, despite rising corporate profits, They are responsible for declining business dynamism, weak productivity, falling wages, and falling share of income paid to workers. That the IMF itself is being concerned that there is excessive concentration and oligopolistic market power across the globe. And this over concentration of power is in fact to be held responsible for low investments that we have just seen, and declining business dynamism and weak productivity, all in fact happening at the time of rising corporate profits. Now, this profit issue is one of the most disguised variables of the economics profession. Even though we love to talk about profits, profit rate in our business schools, and search for the profitability of capital, we have actually a very loose empirical study and definition of what it is. Here, I am going to use the Marxian definition of the profit rate, which is the ratio of the surplus to the value of capital, both constant physical capital plus variable capital, measuring wages. So at the denominator, we have the value of capital plus value of physical constant capital plus wages, wage costs, in the Marxian notion, the idea of variable capital. In the numerator, we have the surplus measured in terms of total profits. The data comes from the European Commission AMECO website, and it pertains to European Union, the European Union 15, and particular countries, Germany, France, and I have also added Japan and United States to the overall picture. Profit rate dynamics is very clear. The falling in the profitability in the adjustment era of 1980s, fall in the industrial profitability, coupled with a rise of profitability enabled by financialization, financial rentier behavior, and it had peaked somewhere around just before the eruption of the global crisis in 2008, 2009, and tended to fall afterward. This general pattern can be broken into broken into advanced and developed countries. The rate of profit margins, now the markup rates, if you take 1990 as one, again data from the AMECO site, has continued to increase in developed economies, but for the developing and the less developed economies, the similar calculations suggest that it is actually something not shared by everyone across the globe, but the developed economies and the large corporations were able to increase their profitability at the expense of the industry and the developing world. However, the UNCTAD data narrate a situation that this increased profitability at the enterprise level did not accompany increased fixed investments. This is non-construction in fixed investments in the developed economies. The dotted trend line giving us the trend of the behavior of fixed investments, excluding construction sector, and the volatile but somewhat with an upward trend is the corporate profitability. And we are in a bizarre and untold story that rising profitability in the developed world did not accompany rising investments, and therefore were not productivity raising. And overall result is declining productivity and the slowing down in the rate of growth. Now, let me shift to a couple of slides on the ecological situation of the world. All of these were happening where the industrialization was mostly on carbon emitting fuel combustion technologies. Fossil fuel based industrialization led to a rise in concentration of carbon dioxide in our atmosphere, measured in parts per million. So in parts per million substances, we have had 400 carbon dioxide molecules. The world was on the average of roughly around 380 ppm of carbon dioxide, and all of a sudden we have seen an acceleration since after the Industrial Revolution to somewhere on the order of 400 parts per million carbon dioxide molecules. This increase is held responsible for the global warming of our planet since Industrial Revolution, somewhat on the order of 0.9 to 1 degree Celsius in late 2010s. Estimates suggest that this rise of 1 degree Celsius of the surface temperature of our planet is associated with this, in the previous slide, with the rise of the carbon dioxide concentration in our atmosphere. And if this tendency continues, we'll see an exponential increase of this linear trajectory to something on the order of 2 degrees and beyond. And by the end of the century, it will accumulate to 7 to 10 degrees of global warming. And by then, life as we know it on our planet will not be possible. And many, in fact, argue that this COVID-19 crisis could have been observed in many other forms. It could have been observed in the rise of parasites in our food production systems, increases of other bacteria in different forms. It could have affected our food chains, and COVID-19 crisis is actually an crisis of this global capitalism, highly volatile, highly uncertain, based on trends that are trends of resource extraction and consumption patterns which are simply not sustainable. And as a matter of fact, most of our current industrialization problems originated from the excessive volatility of speculative finance that characterize the current realm of the markets. Excessive volatility of commodity prices and resource misallocation was actually the problem of the world. All of these had also repercussions on the global labor markets, where since the collapse of the Soviet system and the joinement of China and then India, since 1990s, about 1.5 billion new workers have added to the world's economic active population. The ILO estimates that before the COVID crisis, under the old normal, there were roughly 200 million open unemployed people, and this was roughly about 5% of the global labor force. Very interestingly, against this background, employment creation has dropped off the direct agenda of almost all countries, as the problems of global unemployment and poverty were taking the center stage. According to the ILO, actually the problem is not about the rate of unemployment, but about the nature of employment. The world total employment as of 2019 was roughly on the order of 3.5 billion people. Out of this 3.5 billion people on the world, about 1.4 billion is working under conditions of vulnerable employment. They are not subject to any social securitization. They are mostly unpaid family work or short-term informal employment. In less developed countries, being more pronounced, the share of vulnerable, marginalized, informal employment is about half of the total labor employment that we see in the world today. So the issue is not directly about the size of the unemployment, but it is about the nature of the very employment that is being ongoing in our planet right now. And that therefore the call for decent jobs and more formal social security coverage based jobs. But this inequality, you see, is not necessarily an average inequality. This has more facets, more shapes than one can imagine. In addition to geographical and formal versus informal groups, it has a dimension of gender as well. And according to ILO's calculations, on average in the world, women wage remunerations are on the order of 20% less than men wage remunerations. That the gender inequality is expressed in terms of wage pay on similar occupations. Women are receiving roughly 20% less than men. This average is partitioned across the globe. In United States, Argentina, Australia, it's more than 25%. In countries like Switzerland and Korea, it's less than 30. It's higher than 30%, and it's a serious source of inequality. This is not necessarily shared on average. It is not necessarily differentiated on income groups. If you concentrate on the highest 10% wage income group, roughly well-educated, high technology, high income occupations, formal jobs in our language, it is also more or less at the same caliber. In many countries, among the high technology, formal, decent jobs, the inequality persists. But the ILO also highlights another format of this inequality. It is within women, not necessarily against men. Within women, women who have children against women who don't have children, there is also a severe income gap as well. Women with children in the job markets receive comparatively lower wages in comparison to women who don't have children. This detailed gender inequality within women is very pronounced in Turkey, in China, in Korea, except for a few countries. Otherwise, the role of the game is severe gender inequality and severe within women inequality. Let me switch to how mainstream economics have looked at these matters. This is a famous quote. I am sure many of our visitors, many of our colleagues have seen it before. This is a 2004 remark by a past Nobel laureate, the leading figure in the the ration expectations revolution and the real business cycle tradition, or the architects of what we call the great moderation ever. Lucas argued that of the tendencies that are harmful to sound economics, seductive, the most poisonous is to focus on questions of distribution. That all of this realm that I have been talking about, along with your kind attention more than half an hour now, according to the mainstream architects of economic profession, has nothing to do with economics. They are harmful, they are seductive, and they are poisonous. That economics profession actually should not spend any time on issues of distribution. And this had been one of the traits of the old normal. Well, where have we come? This is kind of concluding comments of my lecture today. Well, we are in a vicious cycle. The global capitalism has produced a vicious cycle. You can start from any point on this self-sustained viciousness, if you will. Let me start from the very top. Declining real wages, stagnant wage incomes, collapsing middle incomes, proletarianization of the economies, leading to severe income gaps, as I've indicated, not necessarily limited to wage versus non-wage source of incomes, but within wages and within ethnic and gender groups as well. This leads to a decline in effective demand. Both consumption demand and other effective components of government consumptions are also reduced, which through Keynesian mechanisms lead to stagnation and a tendency for the profit rates to stagnate or to fall otherwise, which had been replaced, compensated for financial rent-seeking, financialization of the globe, the birth of other financial instruments which had compensated for the otherwise falling tendency of the industrial profit. However, this financialization led to a diversion of financial flows away from fixed investments to financial activities, not necessarily related with expansions of investment and expansions of productivity. As productivities had fallen, this had fueled another round of stagnant wages and another round of deterioration in income distribution. COVID cycle, the COVID crisis had come over this cycle. It had actually affected almost all boxes, all of these 5 boxes equally. It had led to an unforeseen rapid rise of unemployment. It had led to a further fall in effective demand, a further fall in profits, and continued financialization. In young Gregel's lecture yesterday, the global finance capital is trying to compensate its otherwise losses by more speculation, more uncertainty, and more volatility, and more credit formation, and none of which will help solve the productivity decline, but it will definitely help solve the the within financial capital problems, but has very little to do with maintenance of productivity. The answer to the COVID crisis and the answer to this neoliberal globalization crisis are actually hand in hand. We have to break this vicious cycle one way or another. It should be broken either through a wage-led growth regime, enabling a rise in Keynesian effective demand, controlling the excessive financialization and the excessive financial volatility in the global finance world, enabling scarce funds to more investments, more rational use of our planet's resources in renewables, perhaps with, in terms of the upcoming talks in the ideas series, with a more carefully planned greening of our resource activity, with a Green New Deal, both in investment expansion and also the usage of our resources of our planet. Well, as many of our talks end, we have to dream for the impossible and be realistic. Colleagues, many thanks for your very kind attention for this opportunity. I do hope that I have raised more questions that I could have answered. That is our tradition in our ideas meetings, to provoke, to stimulate, to generate discussion, and to leave a better world for our children and grandchildren. Many thanks, comrades. Stay in touch. Vikas and Jayati, the floor is yours. I am at your service.
Thank you so much, Erinç. Well, you know, that was such a wide-ranging and vast and very impressive look at all of the major issues. There are a bunch of questions which I'm going to get onto in a minute. But you know, I want to jump the gun a little bit and ask a question as well first. When you talked about how the new normal that was being, you know, discussed all around is actually now the old normal, and post-pandemic we have a new normal. I'm a bit curious about what. I agree with you that we have to move out of it, but what is the post-pandemic new normal as opposed to the earlier one? Has it changed fundamentally, or is it the same old neoliberal story, but with greater disaster and calamity and so on?
Well, Jayati, clearly we are in the making of history, and yes. I don't think that nothing has changed as of what we are talking today. And definitely new technologies and new institutions have to emerge in response to the COVID crisis. And hopefully we are going to turn this into a shift of paradigm, not necessarily limited to a conjectural answer to the disease, but more of an institutional and paradigm shift. And I think it is our job, and it is the meetings such as these will enable such a mind shift, such an institution shift.
So there are a bunch of questions, Erinç, on the issue of the transition, industrialization and transition. You mentioned that, you know, moving from an industrial heavy economy to a service-led economy generates a stagnation in wages. But isn't this kind of transition inevitable? And so when you talk, and linked to that, then when you talk of wage-led growth, how do you see that in the context of these transitions?
Well, there are there is more than one dynamic ongoing over here that I think must be underlined. In my talk, I have a few sentences in passage indicating that from the point of view of the developed industrialized world, this may indeed, with a strong qualification on may, be regarded as a natural course of historical action, where the industrial society, with not only its technology, but also its institutions, had matured. The participatory democratic institutions, the green activities, the consumer, the rights organizations, and so on and so forth are prevailing. And now we are leapfrogging to an innovation-based technological, the so-called industrial 4.0 and aspirations and the colorful jargon ongoing with that. However, this natural course of history is not shared definitely by the developing world. And their dependency on the manufacturing technology is now being strengthened by an extra dependency on the innovation-based technology-based services. This switch from a highly concentrated industrial conglomeration to even more highly concentrated service-based economies is one of the major reasons producing income inequality across the globe. It has limited job creation capacity. Whatever jobs it creates is mostly highly educated, highly skilled personnel. It requires high incomes to begin with. So the middle income classes cannot replenish themselves with more education and more health facilities. So the income gap is widening. I think one of the key elements of this green new jobs and green employment and green new deal is going back to small scale industries, decentralized units, and more of labor intensive renewables, more labor intensive sources of energy, where decentralized units of industry and new forms of services will be united, and there will be a more healthy expansion from agriculture to industry and to services, not necessarily divided into high technology units. That had been my idea.
Well, you know, related to that, there have been these questions coming in about, back to the whole issue about what COVID-19 will do. And it could be argued that COVID-19 could actually encourage a shift away from these very large, concentrated agglomerations, simply because if it's not this, it could be some other virus pandemic, it could be some other thing that could actually, so what do you make of this possibility that this particular disaster could actually force a shift away from these very large scale kinds of production?
It's exactly what I think we ought to expect and we have to fight for. That is, we have to use this as an opportunity for more competitive, decentralized, localized formations of production and marketing activities rather than this excessively consumption-driven mentality that this hyper-globalization has enabled us an expansion of our consumption basket, but at the very expensive way of resource misuse of our planet.
So there, at one point you had mentioned that there was a decline or stagnation in productivity, but that presumably you meant in the industrial sector exclusively, because your own chart actually shows a significant increase in productivity, which is rising while wages are stagnating and falling. Yes?
So that's the productivity of United States private manufacturing. However, on a global on a national economic wide, when you add all other segments of the society, the labor productivity in US and elsewhere is on a severe decline. I have a chart, I have omitted that, but that's the calculations coming from Gordon, from the data that we have. Not necessarily labor productivity, but also what we call this total factor productivity as well. It's on a declining unit.
Of course, here, Erinç, I could argue with you that it's not such a great thing to improve productivity. That
exactly.
If you actually focus on care services and all of those things, or Definitely. On things that increase the quality of life, you can actually live with stagnant productivity and a better
Definitely.
quality of life.
I cannot agree with more, but I am trying to characterize the mentality of the so-called old normal. You know, competition,
right.
increase, efficiency gains. That's the that was the inner contradictions of what the whole mainstream were arguing about. And
so,
remember,
Tell me.
I started with the so-called globalization leads to harmonious convergence. It's such a facade. It's just a play around with
Sure.
data. It's just that.
Absolutely. So there was a question about the greening of the economy. That basically Kristalina Georgieva, IMF's managing director, has suggested increasing the price of carbon, the introduction of green bonds, and a huge stimulus to combat the pandemic and address climate change. Do you think this is a long-term solution?
Well, we have to price carbon effectively in its through economic and social costs combined. However, having said that, there is a famous remark by David Harvey indicating that if carbon was truly priced, the global capitalism would not be able to function at those true costs. So having said all that, there is a tremendous urgent need to shift away from fossil fuel-based industrial and agricultural production to more renewable-based, carbon-neutral production segments. We have to change not only our production technologies, but we have to change our behavior, our consumption patterns as well. And this is your remark a minute ago that this urgent need for excessive competition, need for growth, need for higher and higher industrialization, I think it's the root of the problem as well. That has to be changed. Whatever cost this COVID is telling us.
So, there is a whole set of questions about how we generate an alternative. So some persons have asked about how the fact that pandemic-related job losses will necessarily harm workers with lower education or with informal contracts and worsening income distribution, but also worsening bargaining power. And therefore, making their situation even worse. How will we prevent a dilution of labor laws and further attacks on the working class? Similarly, another question from someone else is that now that the working classes are more vulnerable than they were a few decades ago, what kinds of forces would bring about the kinds of positive changes that you're talking about? Is there any example somewhere in some other country of someone that's doing differently in globalization, in dealing with TNCs and wage levels in the environment? And what could we look at from there in terms of finding alternatives? And last related question is that since capitalism evolves when it is faced with crises, obviously a very classic Marxian here, do you think that this abuse and use of financialization will evoke policy responses away from neoliberal dominance? So there's a whole bunch of questions around this framing and forming of an alternative.
No, well, very important, very timely, extremely important remarks, questions, and observations. Since social change does not occur by itself on its own. And as a matter of fact, actually, there is a bigger danger in moving away from neoliberal liberalism towards more authoritarian, directly dictatorial forms of state-led capitalism as well. That all around the globe, within our countries as well, these changes are triggering disruptions, not based necessarily on class consciousness, but based on fictitious enemies coming from others, ethnicity, religious beliefs, gender, geographical distance, us versus them. And Samir Amin used to say that global capitalism has reached to a point that it cannot govern the world without resorting to open warfare and direct violence. This is not a remark on the need for military expansion to burn the surplus. It's not a Keynesian observation. It is actually a social observation, seeing that the global capital, in order to shift attention from the class consciousness and the opposition to grow against the system, it has to create a lot of fictitious enemies with its own. And what we have witnessed, unfortunately, in the very near history in the 20th century is full of examples of this shift. So I think at this point, our support for democracy, democratic institutions, participatory democracy, both at the local, national, international levels are more sacred than anything else. That we shouldn't let this COVID crisis turn into the formation of new enemies, fictitious enemies, that the Chinese are responsible of the virus, the Indians are responsible for the loss of our jobs, the Turks are responsible of this and that, the Americans are responsible of this, or the person on the next street is stealing my job, the Syrian refugees. I mean, we have to be in solidarity and have to stand for the rights of humanity and the rights of democratization. I think participatory democracy should be embraced at all levels. And we shouldn't fall into the trap of shifting into more authoritarianism in the name of saving our jobs or wages. We are all concerned, really, and we have to be.
What you're kind of suggesting is that it's going to get worse before it gets better. But
it has to be better. We have to learn. We have to learn.
This is Gramsci's optimism of the will, along with the pessimism of the intellect. Yes.
That is true. That is, I mean, we cannot help but being pessimistic, but pessimistic in the sense that we have to be aware of the dangers. And I think we don't have any further the luxury, and we don't have the opportunity of going through 1930s and 40s of the planet once again, with all the warfare immunization and the technical capable of lifting the planet, all life forms. So we have to be optimistic.
But taking from one of the questions which asked about some positive examples, I wondered whether it isn't also interesting that some of the more successful countries in dealing with COVID in a decent way are in fact those with strong public health systems, a strong tradition of participation. Vietnam, Cuba, the Indian state of Kerala, these are all places that have actually tried to deal with it in a more participatory fashion, and also have a long tradition of very strong investment in public health. Maybe that message, if we can spread more, would actually have an impact. Yeah.
Exactly. These are the institutions based on solidarity, on the very sound economic principle that certain things are not to be left to the commercialization of the markets. They are not subject to the cost and benefit calculus. Health definitely has revealed itself as the prime example. Education, again, or the sharing of technology, these cannot be subject to the whims and caprices of the financial markets or the cost calculations of the transnational corporations. As you quite rightly say, it is very, very informative that the crisis is hitting the hegemonic leader of the global capitalism the hardest, because the whole health system is being commercialized. It's based on the profit motive, and against an epidemic of this proportion, even the most advanced forms of health cannot reach the solution of the problems, compared to quote unquote poor in economics but rich in social solidarity nations like Vietnam, Cuba, and Kerala are being the prime examples of success.
Well, that at least is a slightly hopeful note, Erinç, on which to end. Thank you so much. There is well, I think I'm going to stop all the questions here now because we are ending the time. But I just want to thank you, Erinç, for a very rich and illuminating and very wide-ranging discussion, which sparked a lot of thoughts in my own head, and I'm sure in all the listeners. And just to remind everyone that tomorrow we're going to have a panel discussion on views from South Africa on the impact of COVID. That's going to be quite interesting because South Africa is a very unequal society, but it has, I believe, at least a slightly better response, certainly than in India and probably also in Turkey. So that will also be interesting to hear. Thank you so much, Erinç. That was very, very interesting. And we will be in touch again, comrade, of course.
Thank you so much, Jayati, all the friends, all comrades all around the globe.